Hello, my name is Andre Simpson, and today I'm going to talk to you about depreciation. Why is depreciation so important? Well, depreciation is important because if you're not depreciating your assets properly, more than likely your income is grossly understated, and your balance sheet is also going to be materially misstated. Let's talk about it some more, and then I'll go into some numbers afterwards. Okay, what is depreciation? Simply put, depreciation is when you purchase an asset and you use that asset up. If that asset is going to last you longer than a year, but not indefinitely, over the useful life of the asset, the cost that you're using up on that asset, you're allocating it to the asset. You wouldn't purchase something and use it up all at once. Because of the matching principle, the revenues in that period has to match with the expenses. So if I've used $300 worth of mileage on my equipment or cost on my car, then that is what I'm going to allot to that period to match the revenue, not the full value of the vehicle when I purchased it. I depreciate over time. Okay, so you're saying, okay, well, how do you do that? Explain this some more. All right, we're going to go into it now. Let's say you purchase an asset for $10,000. Now, I want to clarify a few things here. Land is not a depreciable asset, and tangible assets, you depreciate them. Intangible asset, you amortize them over time. But just for clarification, once again, tangible assets, you're going to go ahead and depreciate those if they last longer than, useful life is longer than a year, but not indefinitely. Okay? Purchased a car for $10,000 for the business. Now, let me show you what most business owners that I've been coming across do. And it's not their fault, it's just that they don't have a grasp of accounting. They're not accounting professionals. Their business, they're in the business of making money, not doing accounting. So yeah, that's my job. So hey, I enjoy what I do. They love what they do. So they purchased a car for $10,000, okay? And this is the income statement for that month. They had revenues of 8,000. Well, if they expense the car here, what's gonna happen? 10,000 less 8,000 gives you 2,000. That's a net loss of $2,000. Now, you're saying to yourself, well, what's wrong with that? I've made 8,000, I've spent 10,000. Well, the problem is that when you purchase an asset, you have to of this nature, you have to capitalize it. And by capitalize, I mean you depreciate it over its useful life. This $10,000 here is an asset that's going to go on the balance sheet under the assets, okay? Oh, so now let's write down this net loss. Let's record it over here. Done the wrong way. And we're going to do this again, and we're going to do it the right way, okay? So we're going to remove this. And now we're going to assume that depreciation and expense on this vehicle is $1,200 a year. In my next video, I will show you how to calculate depreciation and the differences between tax depreciation and book depreciation, straight line method, accelerated depreciation. In the next video, we'll do that. But for this particular one, we want to go ahead and work these numbers just to give you a quick grasp of why it's important as a business owner to understand this. So, depreciation expense of $1,200 a year works out to be $100 a month. On the balance sheet, assets are shown net of accumulated depreciation. So that's going to be $100 here. It's going to be 9,900, okay? And car assets. asset. Now, if you hear my stomach growling, it's actually 3 o'clock in the morning. I love this stuff. Now, look at this. Depreciation expense goes here of $100. This is $7,900 in revenue. Okay. This is that's net income. 7,900 done incorrectly. You have net income of, you have a net loss of $2,000 when you've done this incorrectly. Okay. Now, it's very important to understand the concept behind this. So, let me walk you through it again. Depreciation is allocating the cost that you've used up within that period. How much of the asset you've used up to the revenue within that period. You made $8,000 within the period, and to generate this $8,000, you used $100 worth of value of the equipment. Maybe you ran the machine a certain number of hours. Maybe you've decided to go ahead and depreciate based on straight line method. Whatever method you use, you determine that this is how much it takes, how much you use per month in depreciation to generate this income. So it's matched here. Now, let's say you came to me, I own a bank, and you did this the wrong way. You came to me for a loan. And having done this the wrong way, I look at your income statement and I see this is the wrong way. I see this. You have negative $2,000. I see a net loss. In addition to a net loss, because you've expensed this, you haven't capitalized it, so it's not on your balance sheet. So now guess what? Now you have negative income and you have no assets which I can give you a loan against. So you have no collateral and you have negative income. Your income looks like this. Okay, it's trending down. This is your trend corridor. And it's always trending down. Every time you purchase an asset, your income goes down. Now, imagine, if you will, you made a major capital asset purchase of $120,000. If you expense that immediately, making $8,000 a month, okay, over the next couple months, if you had expensed that immediately, right? $120,000. Let's move the number up. Let's push that number up. This was $120,000, right? $120. You'd have a net loss of $112,000. Now, realistically, I'm not gonna lend you any money. I would not. And so imagine if this business is buying assets as it goes along. You go to the bank for a loan, you have no assets, and I say this negative amount, I'm not going to give you a loan. No lender is going to consider you credible. Your business does not look viable. So now let's look at the income statement with this done correctly. Done correctly, here's what happened. You have 9,900 in assets, and your income it's $7,900 for the month. This is a business I, as a banker, would want to lend my money to. This is a business I would want to do business with. Not this one, but this one. This is why I love accounting. It is vital to know these things. In the business environment, knowing this will help your business survive. This is key. Now, having watched this video, I don't want you to go run out and start depreciating all your assets. Because as I said before, you only depreciate tangible assets. And you would not depreciate land, and you definitely would not depreciate cash. And we're going to go over something important. So number one, the cost principle says that the depreciation expense will show up on the income statement, the assets show up on the balance sheet. The matching principle says that the revenue will be matched within the period of the expenses. All expenses will be matched within the period of the revenue. Revenues and expenses match within that period. By following the correct accounting principles, you will reflect the correct information. Your business will reflect the correct information. Your financial statements will not be materially misstated. You will know exactly what your business is doing. This is why I love accounting. This is why this is exciting to me. Thanks for watching my video. I really appreciate your time. Thanks again.